something big might be coming for Tesla and its investors, especially in terms of the company's stock price. Despite its falling stock price and concerns over dwindling requests, a number of stock analysts have altered their profit assessments and price predictions for Tesla stock in the wake of the company's turbulent year, which was characterized by a sharp stock decline that saw shares drop by about 70%. This action was taken in response to worries about Elon Musk's purchase of Twitter and the worldwide economic downturn. But not everyone thinks that the stock of Tesla will continue to decline. Indeed, according to some experts like Edward Jones, now is the ideal time to purchase additional Tesla stock. The financial firm recently changed its rating of Tesla shares from hold to buy, claiming that the company has a distinct edge over its competitors due to its leadership in EVs. Welcome back to Tesla Tomorrow, everyone. The Tesla stock rating has been raised to a buy by the American financial services company Edward Jones. Interestingly, they contend that Tesla's upcoming product introductions will enable the automaker to take advantage of the growing EV industry and that the share price does not accurately reflect its long-term growth potential. Among other things for business owners, Edward Jones provides wealth management services, retirement and college savings plans, including stocks, securities, and mutual assets. With 19,000 financial advisors and a branch network of over 15,000 locations, it provides investment services to clients in the United States and Canada. In addition to managing around $1.7 trillion in assets under administration, the business now maintains ties with almost 8 million clients. In general, funding is only directed toward entrepreneurs and individual investors. Edward Jones's revenue in 2019 was approximately $8.5 billion. Edward Jones has more branch offices across the United States than any other financial institution. With over 15,000 sites in North America, the company has experienced remarkable expansion, from about $16 million in 1977 to about $12.3 billion now. Its yearly revenue has increased. Financial backers shouldn't undervalue the fact that a corporation like this supports Tesla shares as a buy. What has caused them to alter their rating for Tesla shares? Then, let's investigate. But before we do, please remember to like and subscribe if you enjoy this type of content so that you can stay up to date on all of Tesla's news. Jeff Window, an analyst at Edward Jones, started rating Tesla as a hold in 2021. He asserts that Tesla is the undisputed leader in the global market for electric vehicles and that, despite the influx of new competitors, the company's then $800 billion market capitalization already factored in a significant amount of long-term growth, as well as significant achievements and forays outside of the automobile industry. According to him, the market was pricing in an average annual growth in earnings of 30 to 40% over the next 10 years, which would necessitate the successful development and introduction of goods like low-cost vehicles, semi-trucks, and autonomous driving. At the time, Window added that Tesla could only sustain its high valuation if the global EV market kept expanding quickly. A few years ago, this was also the case, and the company today seems to be even more optimistic about Tesla. The firm's analysis recently moved Tesla from hold to buy and put the stock to its core list. In a note to customers, the report noted that worldwide emissions and mileage laws are propelling the rise of EVs despite economic challenges. Additionally, it anticipates that Tesla will maintain a sizable presence in international markets despite growing competition. Jeff Window, an analyst for the company, said that this year's price movement has been appealing. However, investor sentiment ultimately determines Tesla's chances of retaining a sizable EV market share, as well as the success of its new initiatives. Concerns regarding Elon Musk's repeated sales of Tesla shares and his lack of attention to the automaker have put pressure on the company's stock. Window responds, however, that he is not unduly worried about his divided attention because Tesla's top leadership team has the know-how to continue operating the business reliably. He went on to say that Musk will have to establish critical goals, which is crucial for the long-term expansion of the EV manufacturer. He claims that even though worries about slowing economic growth and Musk's time spent running Twitter caused Tesla's stock price to drop last year, the company still has great prospects in 2023, enough to raise the firm's rating from hold to buy. Particularly crucial for Tesla are software applications with recurring subscriptions, such as full self-driving, which are anticipated to generate higher profits. Additionally, Tesla is trying to save expenses and increase manufacturing efficiency. In particular, Continuous battery design advancements ought to lower expenses and contribute to increased profitability, according to Window. Tesla will be able to capitalize on this growing market with the introduction of new products, and the share price of the firm does not accurately reflect its chances for long-term growth. Even though Tesla has a strong management team capable of carrying out its existing operational projects, several other Edward Jones evaluations have also said that the company will gain a great deal from removing its involvement with Twitter. Given how quickly their business is expanding, Tesla is likely to maintain its dominant position in the EV market and contribute significantly to a sharp rise in sales. I acknowledge that in a recent tweet, CEO Cathy Wood mentioned Hertz, an American car rental company, which claimed that the maintenance costs of its electric vehicles were more than 50% less than those of internal combustion engines. She also claims that electric cars have more miles driven, and that the increase is shattering all demand projections more quickly than anticipated. According to Cathy Wood, the need for oil is predicted to decline in the future as more people switch to electric vehicles. According to her, the market for electric vehicles is expanding at a tremendous clip, and it is becoming obvious that more people will be using them in the years to come. The Tesla bull also thinks that the EV market will likely be driven by the possible switch to battery-powered vehicles by 2028 and beyond. The market is anticipated to have grown from $187.36 billion in 2021 to $1,318.2 billion. This will exceed the decline brought on by the epidemic in 2020. The president of ARK Invest predicts that the best period for sales of electric vehicles will be 2022 to 2024. Government policies will be more supportive of this new EV model once it is introduced. In related news, New York recently said that it will build 350 new chargers throughout the city and replace about 925 internal combustion engine vehicles in the public government fleet. With over 1,000 electric vehicles, federal grants will be used to pay for both expenses. This is on top of the approximately $420 million that was authorized at the end of 2021 for EVs and related infrastructure. EVs are currently in high demand, and more are on the horizon. What will happen then? When Tesla introduces a less expensive EV, perhaps one that costs around $20,000 or $30,000, the car manufacturer may be able to take advantage of this need. If they are able to do so, and the results might be significant, given the reduced cost and greater efficiency of this affordable electric car, EV purchasers are probably going to pick a Tesla over another EV. Window mentioned the upcoming Cybertruck rollout in Texas and the possible launch of a redesigned Model 3 later this year when talking about Tesla's new goods. He thinks that both cars will help Tesla's stock market standing and worth to increase. Additionally, there will be increased rivalry in the EV market this year. With more than 1.5 million pre-orders, the Cybertruck is expected to be one of the most anticipated electric trucks ever, even if Tesla won't be the first business to release one. We should also anticipate the semi-truck as a stimulus. Although Tesla stock is currently well below forecasts, there is still a lot to be excited about, particularly given the company's intentions to introduce a number of new products this year. One significant obstacle that Tesla may encounter over the ensuing 10 years is financing its expansion initiatives, as Window pointed out in 2021. He said that Tesla's growth trajectory would be jeopardized if funding turns out to be a problem in the future. But at the time, Tesla was not rated as an investment-grade company. Now that things have changed, we should anticipate better outcomes this time. Edward Jones may have revised its rating on Tesla due to the company's recent investment-grade classification, but even as additional competitors join the market, Tesla continues to hold a sizable portion of the industry. However, this isn't just about EVs, it's also about Tesla's new ventures in energy storage, solar energy, and AV technology. Numerous more projects, such as the robo-taxi and the humanoid robot, are in progress. Should investors continue to have faith in Tesla stock? Tell us how much you think Tesla is worth in the comments section below. Feel free to click on the next video that appears on your screen to learn more about what Tesla has been up to in the past few days. I'll see you there.